Welcome back, everyone, to another King's Crowd podcast. My name is Brian Belay, your host from King's Crowd. I'm joined by two of our guests today. So we have Scott Katoon, industry insider, partner at King's Crowd, startup investor, multi-time founder. Welcome back to the show, Scott. We are also going to be welcoming Teddy Lyons in the second half of this show. Teddy's the senior investment associate at King's Crowd, former investment banker with a background in venture capital, and unfortunately, no longer a huge fan of Taylor Swift. Sorry if this is outing you on your Swiftie status there, Teddy, but since the engagement with Travis Kelce. So on that bombshell, let's get into it for this week. We want to jump into part of news that is relevant to startup investors that was just announced this week, and that is around just this evolving role of retail capital in the private markets. Now, Robinhood has announced that they are going to be launching a new fund that is going to be traded on the New York Stock Exchange called the Robinhood Ventures under ticker RVI, I believe. This still has to be approved by the SEC, but if approved, this would be a new vehicle for retail to be able to get access to the private markets. Now, we have seen some similar offerings from some other companies in the past. So for anyone who is a user of SoFi, for example, you can go into your SoFi account today, and there are private fund opportunities for retail with minimums as low as, I think, $10, $100, $500 for things like ARK Invest, the Cashmere Fund by Sweater Ventures, the Fundrise Innovation Fund. These are some of the different options that are available today. However, what's a little bit different with the Robinhood Ventures Fund is that most of those are closed-end funds and follow kind of that interval fund model. So what an interval fund is you can buy in, right? But the shares aren't necessarily liquid. So they're not trading daily on an exchange. You can maybe redeem them quarterly, semi-annually, that type of thing. The concept, as we have come to understand it behind the Robinhood Ventures Fund, is that if you invest in this, it would give you exposure to some of those market leaders in the private markets. So think names probably like, the SpaceXs, the OpenAIs, the Anthropics, that type of thing. But it will be traded daily on the New York Stock Exchange. So this is a ticker that you'll be able to trade. And what comes along with that, where some of the differences are versus those other private funds, is that it means it could trade at a discount or a premium to the net asset value, the NAV. Scott, there are just always tons of opportunities we're talking about on this show. Given the announcement from Robinhood, where's your mind at in terms of, what is this going to enable, if anything new, for the retail investor?
Every week is another big bomb. Well, I think that there's a lot of impact on the investor. I think there's a lot of impact potentially on all the platforms you named just prior to that. If I were those groups, maybe not SoFi, but if I were the rest of them, I'd be a little nervous right about now. One, this is on brand with where things are going. For one, you're already seeing Sequoia, GC, Andreessen Horowitz, others are listing themselves and registering as an investment advisor. So it is no big surprise then that they would want their funds eventually to also be publicly traded. And in fact, some of them are. Their maturity extension funds or PCVs are in some cases. So the difference here is that all retail can get involved in it. I think if you run a fund that does not trade publicly, let's just all for a second suspend disbelief and assume that all of this gets approved and it's done, because there's still some question marks as to whether that's going to happen, but I'll assume it's going to happen. Why would you invest in any of the things on the screen right here? Because I'm going to tell you right now, like Robinhood, like all the rest of these big funds, they are talking about the pre-IPO 25 index. Top 25 to top 50 companies pre-IPO. So we're not talking about early pre-seed, long shot. That stuff is going to get invested in by Sequoia, who's going to mark it up, and dump it in this next fund. And then you can invest, which, by the way, it's maybe a highlight of a segment coming up here, but that's when you should invest as a retail investor, in my opinion. But either way, the way that this is being set up, if I were running a fund that does not, particularly for retail accredited mass affluent, that does not trade publicly, I would be very afraid, because I think that there is no incentive to invest in something like that when you can get in and out. And I think the conversation about NAV has been like this kind of silly, it's like a way to avoid a deeper conversation. Every quarter, and by the way, Trump just said recently that he wants to get rid of the quarterly financial reporting and have it be annual. So we're already talking about annual. The quarterly financial system that we're on, where public companies, predict their EPS and sales and so forth, that is the effective upgrading of a NAV. That's the right sizing of a ship quarterly. It's going to be annually, even better. All of these funds have been fundraising concurrently for like 15 years. So they're upgrading their NAVs internally at least twice a year, probably more often, maybe 3 times a year as they do their raising. So I don't see any problem with it plugging into the quarterly or annual NAV update and then trade left or right of the NAV. Like that to me is not going to be any complication. I think it falls right in line. I think this is a response directly to the pushback and the shit that Robinhood Vlad got from the tokenized offerings, which I think we don't need to get into this because obviously, we've talked about it before, but like the tokenized offerings that were kind of shunned by the CEOs of the companies whose shares were being promised was more of a marketing gaffe than anything. Like I actually don't think there's anything wrong with the tokenized, retail offering that they did. It's just how they sold it. But either way, it was super clear to Robinhood that there was a lot of interest. It was super clear that it had to be fully liquid. And it was super clear that tokenized offering was not going to be the way to get into retail with it. It was just 3 things happened really quickly. And this is their response. Like 3 months later, we've got a venture fund. So my guess is they're going to work with all of these funds, including their own venture, Robinhood Ventures, who, by the way, I would imagine this is kind of reminds me of the Republic Mears thing. Because Republic Capital has like $500 million invested in all these companies, when they offered Mears in companies that are like the top 10, they already invested in those companies. So like it's pretty easy. Robinhood Ventures is similar, like Coinbase Ventures. They've invested in at least 10 of the top 20 pre-IPO companies, Stripe and those kind of companies. So like I have no doubt that they're going to have a very good fund or a very strong late stage fund. They're trying to solve their own problem too, right? There's less IPOs. So they're trying to create a way to start capitalizing on the volatility and the interest in companies that should be IPO'd in a previous generation, but now they don't. And so now you're going to get them here. Then they're going to go public and you're going to move your asset right from where you bought in a RV1 or I or whatever the hell it's called, straight into your managed investment account, straight into your Robinhood account. Like that's all the seamless, thought process they have. So for the retail investor, I think it's fabulous. I think it gives them exposure. It gives them the ability to get in and out. It keeps them relatively safe and siloed from stuff. I think it makes a job easier for founders to be able to access capital, continue to access capital through retail direct markets. I think if you're raising capital as an institutional VC right now, find another job. Is what I would like. There's a handful, and I have neighbors, and I'm looking out the window at one right now. He's walking his dog, and he's going to be walking his dog for a while. He is a perfect example of someone who's like in financial wealth management sales. And I think that the change of the guard here is that all these guys are going to become wealth advisors, just like the Northwestern Mutual style, and everyone's selling directly into funds. And you, Brian, have been calling this for probably 3+ years now. This like retail private. It's like just a name. It's a word. And right in front of us over the last few months, you've seen all these changes. But this one in particular, Brian, is the one I think that lifts the veil. I think this is a big deal.
Yeah. Just for those who are interested, and again, we won't get too in the weeds, but on the whole Vlad topic with Robinhood and everything they're doing, token offerings, I listened. He was on a podcast. He was at the All In Summit, and he just talks about what the future of that, tokenization in general of the stock market looks like. And it's mind blowing. If you just think about where we are at today, it's as if you went back to like the 70s or the 80s when people are still running around with, stock slips and everything else and to trade back and forth. And then everything went electronic. Yeah. This is like the next evolution of that. But bringing it back to the retail side, right. And just more access for retail investors. It's something we're going to continue talking about. It's a trend that we are seeing. And to make a plug for Investment Crowdfunding Week coming up, it's going to be one of the huge themes that we're going to be talking about there. So again, for Investment Crowdfunding Week, for those who haven't already heard us, King's Crowd is basically hosting this. It's going to be 4 days of sessions from September 29th through October 2nd. And I am genuinely excited about this. Think of just all of the who's who of the industry, whether it's founders, investors, the funding platforms, all of the industry leaders are going to be there. So it's 4 days. We're going to have 20 plus sessions, and we're going to cover everything from deal evaluation frameworks to live startup pitches to regulatory updates and everything in between. So if you're a regular listener of this podcast, if you enjoy our discussions here, definitely make sure you check it out. We are sure you will have just a ton of knowledge that's going to be shared and a ton of good lessons and networking and discussions. So check it out you can go to kingscrowd.com/ICW25 to sign up, completely free. So we hope to see you all there. Now, related to that,
producer Sam, by the way, for putting together an incredible.
Absolutely, yeah. Huge shout out to Sam. Sam has kind of been the man behind the curtains. He's not on a lot of these podcasts, but he produces all these podcasts, and he's been a huge person that's going to make that event possible with ICW. So shout out to Sam. Now, last week, related to Investment Crowdfunding Week, I actually had the chance to sit down with the person who is going to be keynoting and opening our opening session, which is Michael Collins from Alumni Ventures. Funny story. So, I'm based out of Manchester, New Hampshire. Alumni Ventures, it's basically one of, if not the most active venture firms actually in the world. If you look at the number of deals that they invest in, number of investors, and everything else, depending on the year. Also based in Manchester, New Hampshire. So Michael and I were able to sit down and had a quick chat. And I was asking him a little bit about this question, Scott. I was like, where do you kind of see not just the opportunity for investors to be able to get access to these deals, which is really important, but wanted to pick his mind of what does he see as the role of retail capital in private markets. So I'm going to pull up my screen and just play a quick clip. Then would love to also get your take, Scott, just on that. And again, for people who want to learn more and hear Michael Collins talk about this more, he's going to be kicking off and keynoting our Investment Crowdfunding Week, September 29th. So it'll go much more into detail on that date. But here's a quick clip when I asked him that question.
Yeah, I think retail capital has a role to play, especially in the very early stages at the pre-seed and seed level, where companies really, are kind of searching for product market founder fit, if you will. There's startups every day that are just getting going, and there's so much capital in the big institutions that it's not efficient for them to participate in most cases at that very, very early stage. So I think when it comes to kind of going directly and supporting companies, I think, there's a role at the very earliest stages where, it's friends and family, it's pre-seed, it's really trying to get it off the ground.
So Scott, hearing what Mike Collins had to say kind of around that, he talks about some of the role pre-seed, seed. Now, obviously we see much later stage companies as well doing some of this, but where do you see, I'm curious, just your reaction to the role of retail capital in the private markets?
Well, Mike is more successful and wealthier than I'll ever be, so don't listen to me. But I couldn't disagree more, to be honest. I think, well, first, let me caveat. I actually think that he's referring to the entire practice of crowdfunding. He a couple times referenced marketing, product market fit. I think he's referring to retail has a place where early companies are trying to figure out who their people are. And in that case, marketing directly to their customer as early advocates and investors, small stakes, small checks, small size. It's a good spot. Couldn't disagree, or sorry, I totally agree with him. I don't have a disagreement there. That is what crowdfunding was to start with. But it reeks more of Kickstarter crowdfunding than it does equity crowdfunding. That's not really an investment thesis. That's he was referring to it really to the company. There's a place for retail because the company can raise a couple of dollars to get started and find product market fit. Sure. The people, and I actually think I can prove this because I think what we did with Hamilton Lane and Republic is kind of proof. And I think what Vlad is doing now is sort of validation cherry on top of proof. The reality is the person who can least afford high risk is retail. Rich retail, sure. Individual investor, sure. You and I, Brian, we can take a risk. We're not even rich, but we're close enough that we can take a risk and it's okay. Regular Joe retail Joe, as my title says here, my retail Joe version of me, I can't do it. And in fact, if I lose or my money's tied up, I'm so pissed about it that I'm not going to invest in another company. And then now all of a sudden you break the chain. It actually hurts people, hurts companies. So I really think that the safest place for retail to get involved is late in the risk mitigation part of the startup / business / any asset class, the least risk phase before peak. So there's that alpha that gets captured in IPO in the past, and now the alpha is kind of between C and pre-IPO and IPO post. That's where they should play, get a discount, go public within a 4-year period, not an 8 to 12-year period, and see their capital appreciated at a slightly better clip than the markets, which the last 2 years has been hard to beat, but let's just pretend that doesn't happen forever. It doesn't all go stonks go up. That, I think, is where retail should play, and I think that we kind of proved that with the Hamilton Lane Republic deal, and then their response to that was they did the mirrors. So they clearly saw the numbers spoke for themselves, that retail individual investors would like to have access to the same kind of entities and wealth vehicles that wealthy have, but they don't have the ability to sit on capital that's not liquid for 15 years. And that's why the retirement, an IRA for investing is such a big topic right now. And they certainly don't have the appetite, the risk, or really the interest in going to zero. That's for us to play. And I would argue not even for us to play. That's for professionals to play the risks zero game. And so I disagree with him on that front, but I know what he meant, I think.
To clarify too, and you can go back and watch the full podcast. We'll be releasing more clips. So the way I framed it was more around like, what is the role of retail capital from that founder's perspective? Like, what is the value that they bring? And I think to your point, though, there has to be that investor investment fit where the investors have to be the right fit coming in to support them if they're coming into that pre-seed seed stage. So it's, again, going to be diving a lot more in depth. If you want more perspectives on that, feel free to check out Investment Crowdfunding Week. So I want to move on to the next segment here. Welcome back our Senior Investment Associate, Teddy Lyons. Hey, Teddy, how you doing?
Hello. Thank you for the shout out about Taylor Swift earlier. As you can see, I removed all my Taylor Swift items.
There's no album in the background anymore. It's it's a sad day, but
yeah. All I'll say is just Google Catching Kelsey, and then you know everything you need to know about the guy.
Right. There's a good boost for our podcast ratings. We dropped all the keywords we need, so move on to the next segment. So yeah, Teddy, a couple things we want to talk about. We're going to do a deal review with Imago Rehab, but before that, one of the, I believe, King's Crowd portfolio companies, King's Crowd Capital portfolio companies, Healthcare Originals, had an announcement about an acquisition. So maybe you could bring us up to speed on what Healthcare Originals announced this week, and then we can jump into the deal.
Yeah, I'll just sort of set the stage to start. So Healthcare Originals, KC Capital portfolio company, we've featured them quite a lot through podcasts and write-ups and everything. Basically, they've developed a medical device to predict COPD and asthma flare-ups using deep organ sounds in the lungs. So basically, goes on your upper torso, passively listens, learns what's normal for each individual patient, and then can actually detect and notify patients of flare-ups much earlier than anything else can do now. And then from there, respiratory therapists can proactively notify the patient, let them know what they need to do to prevent their symptoms and next steps that they have to take. So amazing company, great founder, great traction. You can read our top deal report on why you should invest. And they close pretty soon. So they had some big news last week. They acquired a company called Imago Rehab. Imago Rehab effectively has built a comprehensive neuro rehabilitation platform, kind of telehealth platform that combines telehealth therapy with proprietary wearable devices, and they're really focused on stroke recovery. And they've done some clinical testing where survivors of strokes saw a 5x improvement in outcomes based on the gold standard testing methodology for stroke patients. And yeah, you can kind of see in the pictures there. It's a glove that the patients work with a neurotherapist through their telehealth platform to help them with their rehab exercises, things like that. So what's not clear here, but I actually talked to this company when they were raising their round earlier this year. Their glove isn't actually commercialized yet. Basically, all what they're operating right now is a telehealth platform with this focus on stroke survivor stroke survivors and patients in that space. And so they both have. So what's interesting is Imago Health and Healthcare Originals have the same lead VC investor in Safar Partners. Safar Partners is a VC firm based out of Boston that they basically back companies that have technology that was developed at elite research institutions. So Healthcare Originals, their technology was developed at University of Rochester. Imago Health, their glove was developed at Harvard, Harvard Bio something lab. I forget the name of it. So yeah, the acquisition, when I first saw it, seemed, and I still think this now, seems to make sense. They're kind of complementary health platforms that combine, monitoring with, online telehealth, kind of have a combined hardware/software capabilities. Healthcare Originals has a lot of experience in infrastructure and wearable devices and remote patient monitoring. So the acquisition, I think, is really seen as a way to get the Imago Rehab glove, which is kind of a key part of their pitch to investors. It kind of helps get that glove to commercialization much quicker, given that HCO already has a device that is commercialized already. So in terms of like the mechanics of the acquisition, we don't know the terms. What's interesting is Imago raised at a $12 million valuation. Healthcare Originals is currently raising at a $13 million valuation. So HCO, Healthcare Originals acquired a majority stake in Imago Rehab, so 50% or more. Given the valuation of Healthcare Originals, like I would assume this is totally guessing, but it was probably at a significant discount to Imago's crowdfunding round of 12 million. And from what I can have read, it seems that HCO has like a 51% stake in Imago. Imago is going to continue to operate as its own company. Investors in Imago Rehab will still be shareholders of Imago Rehab, but it's sort of still a subsidiary of Healthcare Originals. So it's kind of the first time I've seen an equity crowdfunding company purchase another equity crowdfunding company.
While their raise is still live, especially.
Yeah, while their raise is still live. So and the other interesting dynamic is they both have the same lead VC investor. So I'm sure they've been in touch for quite some time, Imago and HCO. But yeah, curious your two's thoughts on VC firms consolidating within their own portfolio, the dynamics at play there, and if you've kind of seen anything like this happen more in the traditional VC space.
Go ahead, Retail Joe. I'll toss it to you.
All right. Short and sweet. I haven't seen a lot of this. Expecting to see a lot more of this. I think you're already seeing kind of off-market consolidation in the venture world. You're probably going to see it and trickle down to our world. I think that this is one of the more exciting pivot points to the business that the three of us spend a lot of time in here, is raising direct and going direct. I actually think that the smartest and probably very common thing you're going to start to see happen, common is relative, fairly regular, is the bunching together of a handful of companies. One example that comes to mind is Nicolytics did that and now became robot.com, and Jonah and a few other guys on that team basically consolidated into a bunch of different companies and now raise bigger capital, and now they're going to raise another crowdfunding as a different company. So I think that this is the way to strengthen, take three companies that are weakness with some good and put them together into a bigger company and then go direct. I think it's going to happen more frequently. And I think that venture firms that previously relied on, big blocks like Sept and others to find secondary are going to do the same thing. And they're going to probably come to crowdfunding and Reg A as well. So I think you'll see a lot of this. It's cool. It's also a great story to see the traction that both these companies had. They're both good companies. It's not a situation where it's like one shitbox marries another one to try to make it less shitbox. Like this is, I think is interesting. I like it. It's great to see.
Yeah, just to build on that a little bit, I think we have seen a few companies be acquired by other companies. Now those acquisitions are usually more of like an asset sale / acquihire. So what that probably means, and again, we don't have internal details, the Imago Rehab looks like they raised $128K during their round, but majority of their funds was raised offline under Reg D.
Yep.
So for investors, this is probably trying to give them somewhat of a graceful exit. To Teddy's point, they're not going to get great value. They're probably being marked down to cents on the dollar in terms of the equity, if they maintain any equity in the acquiring company of HCO. But it's, you could do that, or you could give people nothing. And so I think it's a win-win potentially, as Scott kind of pointed out, where it sounds like the marrying of, these two companies and that technology for HCO is meaningful and going to be important for HCO. And plus, it does allow them to continue to operate, as Teddy was saying. So it's not being shut down. They still see there's more value there. So, maybe it's more of a timing issue, just being able to get traction within the time frame that they need, being able to be put in contact with that company by their portfolio company, like you said, Sapphire Partners.
Yeah, so it's also interesting because Sapphire Partners 6 days ago, I think like the same time this acquisition happened, Sapphire Partners invested an additional $1 million into healthcare originals. So
there you go. Yeah, and I'm not super familiar with Sapphire Partners, but in general, these VCs are usually pretty smart, where they're not going to throw bad money or good money after bad. So if they're doubling down or throwing another $1 million in an HCO after the acquisition, they definitely see something with the potential of that company there.
Yeah, and it will be interesting to kind of track. It's unclear what the management changes will be at Imago Rehab. It looks like their chief clinical officer, I forget the exact title, she's staying on Imago Rehab, but it's kind of unclear what's happening with the CEO and COO. So yeah, it'll be a very fascinating one to track.
Yeah.
As we
a future
forward.
Topic for another week. We should put a bookmark in, but curious about both of your thoughts around, follow-on investments and kind of doubling down versus, spreading your bets among different companies. But that would bring us another probably 20, 30-minute discussion here. So anything else before we wrap up for today?
That is a great topic we should explore in the future.
There's a lot of differing opinions on that too, for sure. So awesome. We'll wrap up. Again, just a reminder, investment crowdfunding week coming up September 29th to October 2nd. Head over to kingscrowd.com/ICW25 and sign up. You can also check out the link in the show notes here. We'll see everyone back here next week for the next Kings Crowd podcast. Thanks all.